4 kilometers below the Pacific Ocean, in total darkness, the seafloor is covered with trillions of rocks that look almost like ordinary potatoes. But these rocks are anything but ordinary. Each one can contain nickel, copper, cobalt, and manganese, the metals needed for power grids, data centers, defense equipment, steel, and advanced batteries. The United States is accelerating a new permit pathway. The international rulebook is being negotiated right now, and one public company has already lifted more than 3,000 tons of these nodules from the ocean floor. If this industry works, we could be looking at the birth of an entirely new source of critical minerals. And for investors, the upside could be massive, but only if a handful of very difficult gates finally open. There are 3 major types of deep-sea mineral deposits: sulfides around hydrothermal vents, cobalt-rich crusts on underwater mountains, and polymetallic nodules spread across the abyssal plains. The investment story today is mainly about the nodules. They form incredibly slowly, as metals in seawater and sediment accumulate around a tiny object, sometimes a rock fragment, a tooth, or a piece of shell. Over millions of years, that process creates a dark, metal-rich stone sitting loose on the sediment. That detail matters. These nodules do not require drilling through a mountain, blasting rock, or stripping away hundreds of meters of overburden. The proposed system uses robotic collectors to move across the seafloor, gather the nodules, and pump them through a riser pipe to a production ship. That sounds simple. At 4,000 meters below the surface, it is anything but. The main target is the Clarion-Clipperton Zone, or CCZ, a gigantic area of the Pacific between Hawaii and Mexico. The United States Geological Survey estimates that the CCZ contains about 21.1 billion dry tons of polymetallic nodules. That is not a company promotional number. It is a conservative geological estimate. And the opportunity is not just one metal. A single nodule can supply 4 major commodities: nickel for alloys and some batteries, copper for electrification, cobalt for high-performance applications, and manganese for steel and battery materials. That multi-metal exposure is the real attraction. A conventional mine may depend heavily on one commodity price. A nodule project can potentially earn value from several products coming out of the same material. Think of it as a critical mineral basket sitting on the ocean floor. Demand alone does not guarantee a great investment, but supply concentration can create a strategic opening. The International Energy Agency says the leading refining countries generated more than 3/4 of the growth in refined critical mineral supply between 2023 and 2025. It also projects that the copper project pipeline could leave supply roughly 25% below demand in 2035. Governments do not just want more metal. They want diversified metal that is not controlled by one country or one vulnerable supply chain. That is why April 2025 was a major turning point. An executive order directed U.S. agencies to accelerate seabed exploration, commercial recovery, processing, and environmental monitoring. NOAA then created a consolidated review process for exploration and commercial recovery applications. At the same time, the International Seabed Authority is still negotiating its global mining code. As this video is being prepared in July 2026, those negotiations are actively underway. The regulatory race has moved from theory to a live catalyst. Here is the proposed production chain. First, a tracked collector vehicle moves across the abyssal plain and gathers nodules from the upper surface of the sediment. An umbilical cable supplies power and control from the ship. Second, the nodules enter a vertical riser system stretching roughly 4 kilometers from the seabed to the surface. Third, a production vessel receives the material and transfers it to bulk carriers. Those ships deliver the nodules to land-based processing facilities where the nickel, copper, cobalt, and manganese can be separated into saleable products. The Metals Company, ticker TMC, and its offshore partner Allseas tested this system in 2022. Their collector traveled more than 80 kilometers, collected roughly 4,500 tons of wet nodules, and lifted more than 3,000 tons through a 4.3-kilometer riser. That did not prove a profitable mine, but it did prove that an integrated collection system could work at real ocean depth. Now we get to the numbers investors care about. TMC's 2025 pre-feasibility study for its NORI-D project declared 51 million wet tons of probable reserves within a larger estimate of 164 million recoverable wet tons. The study estimated a post-tax net present value of $5.5 billion, a real internal rate of return of 27%, and an 18-year mine life. Those are extremely attractive figures for a development stage project. But remember what they are: study estimates built on assumptions about metal prices, recovery rates, operating uptime, processing contracts, financing, and permits. The first commercial system is designed for 3 million wet tons per year. It would use 2 collector vehicles, the Hidden Gem production ship, a riser, and a transfer vessel. Allseas has agreed to complete and operate that system and fund a significant portion of the development cost, recoverable through future production revenue. That alignment is important. Allseas is not simply selling TMC a machine and walking away. It is a major shareholder, an engineering partner, and a future operator. TMC says system commissioning could begin in the fourth quarter of 2027, but that timing is explicitly subject to permits and regulatory approval. Until those arrive, the date is a target, not a guarantee. For public market investors, TMC is the clearest pure-play exposure, but it behaves more like a venture-stage project than a mature mining company. It has no commercial mining revenue. At the end of March 2026, it reported about $119.7 million of cash and a quarterly net loss of $20.6 million. So the stock is not being valued on current earnings. It is being valued on the probability that the resource becomes a permitted, financed, operating asset. That creates a milestone-driven opportunity. A workable commercial permit could reduce regulatory risk. A successful production system could reduce engineering risk. Processing and customer agreements could reduce revenue risk. Each gate that opens can change what investors are willing to pay for the same underlying resource. But the reverse is also true. Delays, restrictive permit conditions, technical problems, or heavy share dilution could destroy value even if the nodules are still sitting there. This is high potential precisely because it is still high uncertainty. The strongest bear case is not that the metals do not exist. It is that the environmental cost may be unacceptable or still too uncertain to regulate responsibly. The abyssal plain is not empty. It supports slow-growing, poorly understood ecosystems, and many sampled species have not even been formally described. A 2025 study returned to a small collector test site disturbed 44 years earlier. The physical tracks were still visible, and directly affected communities remained altered. At the same time, several groups of organisms had begun to recolonize, and the researchers found limited, detectable, long-term sedimentation effects in the old plume area. That is a nuanced result, not no impact, and not nothing ever recovers. Modern collectors may reduce some impacts, but commercial mining would operate at a much larger scale. Regulators still need credible limits for sediment plumes, habitat loss, noise, monitoring, no mining zones, and long-term liability. More than 35 governments, along with several automakers and technology companies, have supported some form of pause or moratorium. That matters because customer acceptance can be just as important as legal permission. So here are the 5 things I would watch. Number 1. NOAA issues a commercial recovery permit with conditions the project can actually meet. Number 2. The environmental review produces measurable limits, and the collector demonstrates it can stay inside them. Number 3. Allseas achieves sustained commercial throughput, not just a successful short-duration test. Number 4. Processing partners consistently turn nodules into saleable nickel, copper, cobalt, and manganese products at the assumed cost and recovery rates. And number 5. TMC finances the build and signs customers without crushing existing shareholders through excessive dilution. If those 5 gates open, this stops looking like an ocean science experiment and starts looking like a new mining industry. My bottom line is that deep-sea mining has genuinely massive potential. The resource is real, the strategic demand is real, and the technology is further along than most investors realize. But the opportunity is not de-risked. Today, TMC is best understood as a public option on regulatory approval and commercial execution. That makes the next 18 months potentially transformational, not only for one company, but for an industry trying to move from the seabed into the global metal supply chain. If you enjoyed this deep dive, leave a like and subscribe to Risk on Capital for more company research, emerging technologies, and long-term investment stories.